When a sale is made to a customer on account to be paid in the future, the source document that is used to track that sale is an invoice. An invoice is a legal document that details what is purchased, how much it costs, who purchased it, and where it's being shipped to. There's also a place on the invoice that explains when the invoice needs to be paid back. The details of when an invoice needs to be repaid are known as the terms. For many invoices, the terms are simple and state only when the full balance is due back. For example, an invoice might have terms that state it is due in 30 days. That means that the customer must pay the full amount in 30 days. Sometimes, however, the vendor doesn't want to wait the full 30 days. They'd rather have the money sooner. So they add an extra term that says if the customer pays early, they will reduce the amount owed on the invoice. This is known as a sales discount. For example, let's imagine that the terms of the invoice were due in 30 days with a discount of 2% if paid in 10 days. This means that any amount paid in the first 10 days since the sale would be reduced by 2%, and the full balance is still due in 30 days. Sales discount terms are used by some businesses as an incentive to customers who have extra cash to pay off their invoices early so that the vendor can reinvest that money in more inventory faster. Because there isn't much room on the invoice for the terms, discounted terms are often abbreviated. In our previous example, we used terms that were due in 30 days with a 2% discount if paid in the first 10 days. This is abbreviated as 210 net 30. A 210 net 30 discount term is one of the most common discount terms. Let's look at an example of how it is calculated and recorded in the accounting system. Let's imagine that a customer bought $4,000 of product from us on August 3rd on account with the terms 210 net 30. Now remember, the discount isn't guaranteed. The customer only gets the discount if they pay within the first 10 days. If they pay after the 10 days, it's just a sale on account like we've seen before. Let's imagine, though, that the customer decides to pay the full invoice on August 9th. That's 6 days after the sale, so it's within the discount period. So they get to take the 2% discount off their sales price. We would find the discount amount by multiplying the $4,000 of sales by the 2% discount. That would be a discount of $80. The customer pays the original sales price of $4,000 less the discount, so cash would be debited for $3,920. How much would accounts receivable be credited for? If we credited accounts receivable for just the $3,920, it would leave $80 that the customer still owes. That's not right because the customer paid early and used the discount, so they don't owe us anything anymore. This means that we need to credit the accounts receivable for the full $4,000 to bring the balance to zero. The extra $80 difference will be a debit to an account called sales discounts. Sales discounts is a special kind of account known as a Contra Account. A Contra Account is related to another account in the chart of accounts, but always has an opposite normal balance to reduce whatever account it is related to. In this case, sales discounts is a Contra-Revenue account. It is related to the revenue accounts, but instead of having a credit normal balance like sales, it has a debit normal balance. This makes sales discounts a negative always, which reduces sales. This makes sense because we reduce the amount the customer paid because they paid early. So we really have less sales revenue now than we originally did. Contra accounts are often used in accounting as a way of reducing an account so that there is a clear record of why and how much it is reduced. Now the shareholders and other stakeholders can see how much we earned in revenue and how much we lost to discounts. Sales discounts is just one example of contra accounts. We will see more contra accounts later on in this course. Just remember that contra accounts are accounts that have opposite normal balances as the accounts around them, and always show as a negative balance on the financials because of that. So now we finished our journal entry for sales with a discount. Remember that we debit cash for the amount the customer paid, less the discount. We also debit the sales discount account for the amount of the discount so that the credit to accounts receivable is the full amount of the invoice. To learn more about sales discounts and other contra accounts, check out more of my videos on YouTube or visit torinorman.com.